Good morning, and welcome to the De-Risk Global Markets Daily Brief. It's Friday, November 14th, 2025. Yesterday, we asked if the market's post-shutdown reality check would come in the form of the October CPI report. Well, we have our answer. There is no answer. The data was not released, plunging markets into what we're calling the data void. The optimism that had been fueled by rate cut speculation has evaporated, replaced by the stark realization that without reliable data, the Fed is flying blind, and so are investors. This uncertainty has triggered a classic risk-off cascade. U.S. equity futures are pointing to a deeply negative open, with the Nasdaq 100 down a sharp 1.33% to 24,761, and Dow futures off 0.51% to 47,305. But the real tell is in the volatility market, where the VIX has exploded, surging past the critical 20 level to close above 22. It seems the market's mantra has flipped from bad news is good news to no news is a crisis. So, Alex, this is a dramatic shift in sentiment. Walk us through how this wave of uncertainty and fear washed across global markets overnight.
It's a powerful shift, Sarah, and the price action shows a clear and accelerating move towards risk aversion, starting in Asia and gaining momentum through the European session. In Asia, markets were the first to digest the implications of the U.S. data vacuum and a sharp overnight tech sell-off. Japan's Nikkei 225 pulled back, closing down 0.77% at 50,376.53. While that's a notable drop from its open of 50,767.74, the index remains firmly above its 50-day moving average of 47,339, keeping the longer-term bullish trend intact for now. It was a similar story in Hong Kong, where the Hang Seng slipped 0.33% to finish at 26,572.46. It too held above its 50-day SMA of 26,263, but the selling pressure was palpable, amplified by fresh data showing a cooling Chinese economy. As the handover to Europe occurred, that caution morphed into outright selling. The German DAX was the session's weak link, suffering a significant technical breakdown. It tumbled 1.37% to close at 23,648.33, decisively breaching its 50-day SMA of 23,991.73. That's a key support level gone, suggesting the potential trend reversal. London followed suit, with the FTSE 100 falling a steep 1.86% to 9,625.17. While it managed to close just above its 50-day SMA of 9,479.79, the severity of the drop from its 9,807.72 open signals that Europe's own weak growth narrative is now being compounded by the chaos in the U.S. Now let's turn to the U.S. cross-asset picture, which is the epicenter of this repricing. The bond market is flashing clear warning signs. The 10-year Treasury yield is holding at 4.112%, reflecting a flight to the safety of government debt as recession fears mount. In foreign exchange, the U.S. dollar index is in a precarious spot. It slipped to 99.21, remaining below its bearish 200-day moving average of 100.25. The dollar is caught in a tug of war. Fading December rate cut bets should be supportive, but the data void is making global investors wary of U.S.-centric risk. The commodity markets tell this story of fear perfectly. Gold, the ultimate safe haven, consolidated its recent gains. It closed at $4,115.60, pulling back from its open, but still trading far above its bullish 50-day SMA of $39.33. In stark contrast, WTI crude remains trapped by global growth fears. It edged higher to close at $59.51, but that's still deep in bearish territory, well below its 50-day SMA of $61.18. Finally, the main event, volatility. The VIX surged a massive 10.4% to close at 22.08. This isn't a warning shot, Sarah. This is the fear gauge signaling that the market's complacency has been shattered. The data void has pulled the rug out from under the market.
That's an incredibly clear breakdown, Alex. The rug has indeed been pulled out, and the market is now grappling with pure, unadulterated uncertainty. This data void has completely upended the narrative, shifting the focus from policy speculation to fundamental economic risk. Looking ahead to the U.S. session, with the official data pipeline still frozen, the market will be starved for information. This puts an immense weight on the few data points we do have, and more importantly, on any guidance from the Federal Reserve. The University of Michigan's Consumer Sentiment Survey will be a critical release. The preliminary reading for November already showed a shocking plunge to 50.3, its lowest since mid-2022, as the shutdown rattled households. Any further deterioration in the final number will amplify fears that the consumer, the bedrock of the U.S. economy, is cracking. Beyond that, all eyes will be on Fedspeak. We're scheduled to hear from New York Fed President John Williams later today. In this data vacuum, his tone will be everything. Will he signal patience and downplay the shutdown's impact? Or will he acknowledge the growing economic damage and hint at a more accommodative stance? Without hard data to guide them, traders will parse his every word for clues, making for a potentially volatile session as the market navigates this fog of uncertainty. That's all for this episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.